Hi everyone, a very warm welcome to you. Thank you for joining us today. My name is Serena and I'm the lead APAC market analyst. Joining me today is Emma, our China market analyst.
Hello everyone.
And Arthur, our lead freight analyst.
Hi everyone.
So the theme of our presentation today is centered around China's recent series of policy changes on its refining industry, as well as the rippling effects that it has on the global oil market, as well as the tanker market. We will also be discussing some of the new opportunities and trading strategies that have evolved under this new regime. So some administrative matters before we start. This session will comprise of a 30-minute presentation followed by a 10-minute Q&A. So if you have any questions for us, feel free to pop it into the Q&A box below and we'll try to answer as many questions as possible. Towards the end of the presentation, we will also be sharing a copy of the slides with you. So with that, let's begin. So the key agenda and the key takeaways for this presentation will be as follows. Global oil and gas supply tightness is really driving energy prices through the roof this time. And at the same time, we've seen this year China's strategic shift in its refining focus, moving away from being export-driven to being more self-sufficient. And in doing so, this has kept its crude imports and product exports. Meanwhile, we've seen other Asian refiners finding new export opportunities both within the region as well as to the West. And this shift in the market dynamics has led to clean tonnage demand outpacing the dirty segment. So with that, I'm going to pass on the time and invite Arthur to give us an overview of what's happening in both the oil and the gas market today.
Thank you, Serena, for the introduction. I'm sure the majority of our audience would have by now seen the headlines at the start of the week as oil prices hit multi-year highs on the back of recovering demand with corresponding increases in supply really failing to follow suit. So if we look on the left-hand side, and look more closely at OPEC plus crude oil exports, we can really see that even as regular 400,000 barrels per day increases are announced, the reality is much more subtle. We can see with our data that volumes are in majority driven by a rise in Saudi Arabia and UAE crude exports, with the remainder of OPEC plus really failing to not only increase those exports, but also maintain them. And that sort of flat supply situation combined with a more bullish demand outlook as oil and products consumption rises is naturally supportive of the headline oil prices. Brent prices are now at a 3-year high. US crude prices are at a 7-year high. And it won't be easy for producers outside of the alliance, such as the US, to ramp up production from one day to the next to dampen the price increases. A $100 barrel of crude at the end of the year doesn't seem as far-fetched now as it did a few months ago. On the right-hand side, we can see that gas markets are currently suffering from the same fate. We've got a fundamental lack of supply and few producers are able to respond, which is really, again, that driving force behind the rise in both commodities. So for LNG, the market has recovered from COVID-19 demand shock, but late last year, facilities have yet to reach full capacity again. And the US has been a key contributor to growth in recent years. Now we can see that even though exports have been curtailed and on a bit of a downward trajectory this year, there is a seasonality element to this drop. In the meantime, prices have reached a tremendous $190 a barrel of oil equivalent basis JKM and show no sign of abating their meteoric rise really. Back at you, Serena, to dive right into the heart of the topic at hand with China's recent policy changes.
Thank you so much, Arthur. So stepping into 2021, the world was really looking towards a strong recovery in China's seaborne crude imports on the back of a robust economic recovery as well as its expanding refining capacity. And true enough, the first quarter of this year really saw China's seaborne imports starting on a very strong footing at 10.4 million barrels per day. But everything kind of took a turn in the second quarter when the Chinese government introduced a series of policies aimed at the refining industry. So first, it started off by implementing a new consumption tax on diluted bitumen, which really eroded independent refiners' appetite for the imports of Venezuela's Miri crude that are typically declared as diluted bitumen during the customs. And now what this means is that the independent refiners no longer enjoy as attractive discounts as prior to before the consumption taxes. Now, on top of that, the Chinese government also reduced the crude import quotas given to the independent refiners in the second and the third batch of import quotas. And this has further capped the amount of crude that they could import for the rest of the year. The state-run refiners were not spared either. In the second batch of product export quotas issued in mid-August, the state-run refiners saw that their product exports were significantly reduced in this batch compared to the same batch in the first half of this year, as well as the second batch in the second half of last year. So what this means is that they no longer can depend on product exports to export their surplus products, and a lot of their refining runs will be very much driven by the domestic demand. On top of all these policy changes, the Chinese refiners also were driven to draw down on their crude stockpiles as a result of very high crude oil prices. We saw that between the end of 2019 as well as the third quarter of 2020, China actually built an additional 130 million barrels of crude stocks, but all these have all been drawn down by this September. The Chinese government also encouraged the Chinese refiners to draw down on stockpiles by publicly releasing some SPRs to them, and all this in a move to actually dampen the DES crude prices into China. So the net effect that we're seeing with all these changes is that China's seaborne crude imports between June and September have really fallen by close to 17% compared to the first quarter of this year. And with that, Emma, I'm going to pass on the time to you for you to share with us what you see in terms of the trajectory of China's crude imports in the last quarter of this year.
Thank you, Serena. We can analyze China's Q4 crude demand at two levels, the state-owned refiners and the independent refiners. State-owned refiners like Sinopec and PetroChina do not have any crude import restrictions, but their clean product exports are capped by export quotas, which have been drastically reduced, as Serena mentioned earlier. This means that their refining runs and in turn crude imports is largely predicated upon domestic demand in Q4, which is likely to see a rise from a few directions. First, increased road and air travels during the national holidays will raise demand for gasoline and jet. Second, seasonal rise in construction activities is driving up diesel demand through to end of November before winter. And lastly, the new power rationing in multiple provinces may boost diesel consumption in power generation. As for the independent refiners, their crude imports are largely capped by import quotas. While the market anticipates the government issuing a fourth batch of crude import quotas for the year by end of October, we expect that it will be granted on a needs basis and is likely to stick to its course of rationalizing the country's refining capacity. In that sense, integrated refining complex Shenghong is likely to get 2 million tons of quotas for its startup, while Hengli and Zhejiang Petrochemical may get some extra allowance to match up their capacities. But for the conventional independent refiners, although some of them are in hope to get quotas in this round, as they didn't get any in the previous rounds, they may not get quotas as much as last year. Besides quotas, Beijing has proposed to broaden emission control ahead of Winter Olympics in surrounding areas, which may limit refining operations in Shandong and Hebei. So overall, we expect China's crude imports to pick up in Q4, but it is not likely to return to the levels seen in Q1 this year. Now, let's take a closer look at China's imported crude types. Looking at China's crude imports by origin, we're seeing a trend of divergence between imports of Middle Eastern crude versus other spot barrels from countries like Angola and Brazil. Although China's total crude imports saw a decline from June, imports of Middle East grades remained relatively robust, as you can see from the chart on the left, and their market shares continuously picked up. Meanwhile, inflows of spot barrels from Angola, Brazil, Norway, and Russia fell, as seen from the chart on the right. With a wide discount of Dubai to Brent, Chinese refiners have retreated their purchases of Brent-linked spot barrels and held onto the Middle Eastern grades. In particular, Saudi crude imports are expected to be strong in November, as Aramco cut October official selling prices for Asia-bound crude by $1 to $1.3 per barrel versus September levels. On the other hand, top African oil producers, Angola and Nigeria, are seeing unstable production due to underinvestment and nagging maintenance problems. Together with limited import quotas for the Chinese independent refiners who favor these grades, the African crude exporters have lost their market shares to other OPEC producers. This shift of China's crude origins also has a major impact on dirty VLCC freight. I will pass to Arthur to share some insights on this.
Thank you, Emma. Now, what has been the impact on freight? Well, it hasn't been good. It's no secret that China has an outsized influence in crude oil markets as the world's largest buyer. And that's particularly evident when it comes to freight on VLCCs, with the majority of VLCC trades having China as an end destination. Now, China remains what I would call a pragmatic buyer. And as the price of crude has recovered, we can really see that inverse trend followed by China's crude oil rivals, as previously presented by Emma. And thus we can see the impact on ton miles. We can see from the chart, when it comes to VLCC crude to China, ton miles have done nothing but fall this year. And they're at their lowest level in 3 years. And even their lowest levels going back to 2016. Now, if we translate that ton mile data into utilization, looking at unique vessel counts, in January of this year, we had about 160 VLCCs loaded with crude heading to China. Now that number stands at about 80 today. And that's really a mind-boggling 50% drop in utilization levels. When it comes to global crude exports on the right-hand side, we can really see, what was presented by Emma previously, being matched in where VLCCs obtain their cargoes. So we've seen declines in key markets such as the US Gulf, West Africa, and Middle East exports are really the only remaining relatively stable market for VLCCs. Declining West African exports, especially to their lowest level since at least 2016, according to our data, are especially guilty of the lack of VLCC employment and poor rates for this year. Now, talking about rates, paradoxically, when it comes to earnings, we've actually witnessed an uptick across the board, even as September closed on a record monthly low for VLCC ton miles to China. Now, our data suggests this is the result of 2 factors. So first of all, we've got a rise of laden tankers from the Middle East Gulf as crude loadings have risen, especially from key export producers, Saudi Arabia and the UAE, to clear available cargoes for October loadings. And there's been a sort of cascading effect with Middle East rates edging higher and this impacting positively the other markets. And furthermore, there's been a continuous drop in VLCC ballasters headed west of Suez, which has also constrained the available tonnage in the Atlantic Basin and supported freight rates from the US Gulf Coast or the North Sea for that matter. However, as Emma previously mentioned, imports will probably not recover before next year. Even though we'll see a slight uptick in Q4, it will remain low. And as total crude in transit as well remains range bound, we don't believe this uptick is going to last. And we've already started seeing rates revert down over the past week. Back to you, Emma.
Thanks, Arthur. Let's continue with China's imported crude types. Besides normal crude barrels, steep discounts of Iranian crude and Venezuelan crude has kept trades of these sanctioned barrels strong, despite tighter crude import quotas issued to the independent refiners. China's imports of Iranian crude have averaged at over 500,000 barrels per day in the first 9 months of this year. Similarly, imports of Venezuela's Mare blend, favored by export producers, were estimated above 300,000 barrels per day in the same period. Some interesting dynamics that we would like to highlight here is that traders and refiners typically import Iranian heavy crude barrels and report them as other Middle Eastern grades at Chinese customs to divulge the origin. Similarly, Mare crudes were mainly reported as Malaysian grades to mask their origins, and they were largely imported as Malaysian diluted bitumen since Q2 last year to bypass crude import quotas. And this year, part of Iranian crude cargoes were also imported as diluted bitumen to save on crude import quotas. And that's why the trade of official diluted bitumen figures, as shown in the left chart, are in line with Vortexa's track of sanctioned crude imports until June, when consumption tax was levied on imported bitumen mixtures. Besides crude, some independent refiners also turned to fuel oil as alternative refining feedstock. We also noticed that some crude cargoes were imported as fuel oil or natural bitumen to bypass crude import quotas. As of today, our data shows more than 20 vessels on board with sanctioned crude cargoes anchored offshore China. Some of them have been floating over months due to quota shortage. On this basis, independent refiners may continue to purchase straight-run fuel oils from East Russia and Singapore until they get more crude import quotas. Regarding the sanctioned tankers, Arthur, can you share with us some interesting trends you are seeing?
Of course, Emma. Now, this is really super interesting. According to Vortexa data, we've got a total of 878 unique vessels that were involved in sanctioned barrels transportation since January 2018. Now, that's 8% of the global energy carrier fleet. I'll let that number sink in. And it's really had a notable impact in freight markets, especially on the larger sizes, such as VLCCs and Suezmaxes. What it does is it keeps compliant tonnage unemployed. It also helps jack up secondhand prices of older tonnage. And that limits the incentives for scrapping and really contributes to that continued oversupply of tonnage in crude tanker markets. Now, we have a team of analysts here at Vortexa that are really focused exclusively on tracking these tankers. They're very difficult to track, obviously, due to the dark nature of the trade, the illicit nature. And we have a unique partnership with Winwood as well. And that helps us identify at-risk tonnage. And we're keeping a close eye on sanction flows in order to get those fascinating insights, such as the one just shared by Emma.
Thanks, Arthur. So just moving on from crude imports to product exports, we saw a similar trend whereby China's product exports saw a sharp decline in the third quarter of this year, with volumes in July really falling to a year-to-date low. And the government has intentionally sought to limit state-owned refiners Croatia's clean product exports by cutting back on their export quotas. Subsequently, we saw clean product exports from China rising in August and September, but we think that the September levels are unsustainable through to the end of the year. And this because, based on Vortexa's analysis, we think that the Chinese refiners have used up almost 80% of their total product exports for the year, and that leaves them with around 20%, which is equivalent to around 650,000 barrels per day of product exports for the rest of the year. And this figure is at least 100,000 barrels per day, lower than September's levels. Now, if we look at the breakdown of the exports by refiners, we see from the right chart that PetroChina suffered a drastic fall in its export market share in July, really due to a lack of export quotas. And with the second batch of product export quotas that has been issued, PetroChina has also used up almost 3/4 of its export quotas for the full year of 2021. And that leaves it with around 26% or 25% for the rest of the year. This really contrasts with its other competitor, Sinopec, which has over half of its export quotas remaining. Now, our ability to track cargoes real-time down to the terminal level allows us to understand how much export quota each refiner has used up, and in turn derive an outlook for each of them for the rest of the year. So with China's sharp pullback in clean product exports, this has really tightened supplies within the region. And we've seen regional exporters such as South Korea and Taiwan really stepping up to increase their exports into Southeast Asia. So in the chart on the left, we saw that South Korea's clean product exports to Southeast Asia has risen by over 40% between June and September, while Taiwan's exports to Southeast Asia within the same period has risen by almost 60%. But the exports growth for these two countries into the region has really been very much kept by the lackluster oil demand in Southeast Asia. So here in Vortexa, we use Southeast Asia's transportation fuel imports as a proxy to demand that gives us real-time update of how demand is performing before the customs data is out. And as you see from the chart on the right, Southeast Asia's gasoline and diesel imports, excluding Singapore and Malaysia, it's about 85% compared to this year compared to the pre-COVID 2019 levels, while jet imports is still very low at about 35%. And this tells us that Southeast Asia has quite a long way to go in terms of its demand recovery. But fortunately for Asia's regional exporters, an open east-west arbitrage has provided a disposition for them to export the surplus jet kero and diesel barrels into the more distant markets such as US, Africa, and Europe. And in this slide, we see that a strong positive jet fuel arbitrage from North Asia to the US has encouraged refiners from South Korea as well as Japan to export more jet fuel to the US in these 2 months. But in the last month in September, the arbitrage has narrowed and therefore we saw a decline in exports to the US. But what's happening instead is that we've seen more jet fuel cargoes heading to Singapore for either storage or reblending to diesel gas oil, or to Europe despite the thin margins. Now, the current economic does not support long-term jet fuel storage, which means that those cargoes heading to Singapore will likely be quickly re-exported in the short term or blended into gas oil. As for the arbitrage into Europe, we think that the Asian flows could face challenges because of rising supplies from shorter haul markets such as Russia and the Middle East competing with market share in Europe with the Asian barrels itself. In the weeks ahead, we also think that some of the South Korean refiners could be switching their yields to produce more kerosene and availing less jet fuel supplies into the region. And that will also support jet kero cracks going into the fourth quarter of this year. As for diesel, well, it's really the perfect storm of rising seasonal Europe demand and tight supplies from US as well as Russia because of the tropical storm disruptions, as well as the heavy refinery maintenance. And that has pulled the longer haul Asian diesel barrels over into Europe, which we saw over 280,000 barrels per day heading to from Asia to the Europe in September. Now, we believe that arbitrage flows could remain robust in the fourth quarter, given Europe's really robust diesel gas oil demand in this quarter. But we think that the upsides could be really kept by more supplies coming from the US as well as Russia competing with the market share with the Asian barrels itself. Now, besides Europe, we've seen additional arbitrage opportunities for diesel opening up to the Indian diesel cargoes. So what's happening is that India's lackluster domestic demand has led to a growing surplus of diesel within the country. And for South and East Africa, its growing diesel demand has allowed more Indian diesel barrels to head towards these markets as an arbitrage opportunity. So Arthur, have you seen any interesting trends around the new build VLCCs carrying clean from Asia to the West recently?
Absolutely, Serena. We've definitely seen that trend, loading diesel from Asia to the West. We're currently tracking 2 tankers, the VL Renaissance and Nave Electron, loading diesel in Tanjung Pelapas and en route to Lomé. Now, they could potentially be doing a partial discharge before heading to Europe. And with the open diesel arbitrage between Asia and Europe, as you mentioned, we could expect to continue seeing more new build VLCCs loading clean to the west in the coming months.
Thanks, Arthur. I think that's an excellent point. So now that we've examined the opportunities for product exports, let's now turn our attention to the feedstocks imports of two major Asian refiners, South Korea and India. So as you see on the chart on the left, South Korea's crude imports have for the first 8 months been languishing below the 2019 as well as the 2020 levels because of the weak domestic demand and export margins. But the stronger cracker margins have seen refiners ramping up to produce more naphtha amidst the eye-watering naphtha import premiums. And in fact, talking about naphtha, South Korea's naphtha imports this year has really been very strong, stronger than the 2019 as well as 2020 levels, mainly for two reasons. First of all, the startup of 2 new crackers in Yeosu in June this year. And second of all, the peculiar trend that, in this year we saw minimal naphtha to LPG switching in as a cracker feedstock because LPG was less economical than naphtha in terms of the fact that, the prices was higher in the summer as compared to the typical previous summer seasons. And therefore, naphtha remained as the dominant feedstock for the ethylene crackers. As we head into the fourth quarter, we think that LPG prices are expected to remain at a premium to naphtha. And because of that, naphtha will continue to remain as the main feedstock for ethylene crackers. And this will continue to support a robust naphtha imports into South Korea and the wider North Asian countries. Now, as for India, although India's crude imports have really recovered in the first 9 months of this year as compared to last year, we see that the imports are still lagging below 2019 levels. But what's interesting is that in the third quarter, India's domestic gasoline demand started to see a very strong recovery because of the pickup in passenger car travels as a result of the festive seasons, as well as the lifting of the travel restrictions. Now, on the contrary, diesel demand has really been lagging because of the weaker recovery of industrial as well as construction demand, coupled with the impact on the monsoon season. So with a strong gasoline and a weak diesel demand, what happens is that we started to see Indian refiners shifting towards purchasing more gasoline-rich crude grades coming from West Africa as well as the US in September, and also backing off some of the Middle Eastern crude imports. But we think that this trend is not sustainable going into the last quarter because we've seen a very sharp rise in and the widening of the Brent to buy differentials in the final 2 weeks of September, which has made the Brent-linked West African crude grades much more expensive and in turn less competitive as compared to the Middle Eastern grades. But overall, I think India's crude imports is likely to see a recovery in the fourth quarter as compared to the last quarter, really very much driven by all the positive market factors that are driving up the overall domestic demand within the country. So Arthur, there's quite a lot of trends to unpack over here, but on this basis of the shift in trade flows, could you talk us through how the East of Suez tanker markets is actually performing?
Absolutely, Serena, thank you. Now, it's been a bright spot when you talk about East of Suez. As we've seen in the previous slides, rises in exports from Asia have occurred at a time of limited product demand in the Eastern Hemisphere amid COVID restrictions. And on top of all that, we've also seen gasoline demand previously satisfied by transatlantic flows within the Atlantic Basin, now helped by flows from the East of Suez. We've seen faltering Russian diesel exports towards Europe. We've seen limited PAD 3 exports as well towards LATAM after the hurricane season. Now, all these factors combined have really contributed to that steady rise of ton miles ex-East of Suez full CPP tankers, reaching that annual high in September 2021. Now, whilst levels have steadied for Asia, and we've seen a very recent drop-off the past week for other regions, otherwise, it's actually been quite a good year. Now, higher ton miles can be used as a proxy for higher demand for transportation. So it's no surprise that this translates to higher freight rates. On the right-hand side chart, you'll see an aggregate of rates comparing both Atlantic and Pacific basins. And we can clearly see the favorable economics for tankers loading East of Suez. At the height of the spread in earnings between the two baskets last month, time charter rates in the Pacific were 10 times higher than in the Atlantic. So we're talking here $11,000 a day compared to 1,100. More recently, fixtures still put those levels at 2.5 times. Now, that recent drop-off in both ton miles and earnings really begs the question in terms of what lies in store next, and whether stronger CPP markets compared to their crude counterparts will last. So on the supply side of the equation, we've really witnessed that steady rise of CPP tankers ballasting from the west to the east of Suez. And that makes sense. They've been hunting for more cargoes and high earnings. But the flip side effect of that is the ever-increasing tonnage available now east of Suez. And that really risks capping earnings. And it's already started to give charterers more options, as we've seen in the lower rate indications in the previous slide. For me, it's really a strong visual representation of what successful trading really is. And that is that it's all about timing and being able to catch that tipping point between a strong and a weak market based on the fundamentals. And our data can really help to illustrate that and catch that early on. Now, the outlooks also look mixed for freight markets if we look at the individual product dynamics on the right-hand side. So when it comes to gasoline, it seems Asian producers are ramping up their own domestic production to meet that transportation demand, which otherwise doesn't really have a lot of room to grow. When it comes to the transatlantic arbitrage, that has eased. We've seen US refiners are coming back, and it's likely that gasoline won't be that engine of growth for CPP tanker markets. Diesel and naphtha, it's a bit more of a nuanced picture. So while US refiners are back to supply markets such as LATAM, and Russian diesel exports are expected to increase to meet that peak winter demand, that might mean less cargoes being brought from the east to the west, even as the arbitrage is open. And just to add again, diesel volumes are exposed to being carried on large new builds, which could further limit employment opportunities for CPP tankers. And the story is similar with naphtha. We're already starting to see a cooling down in freight rates. We're seeing that recent momentum in naphtha exports is faltering, but we're also entering a seasonally strong period for naphtha, which means it could go either way. Now, to finish on a positive note, jet cargoes seem ever in demand with plenty of outlets globally. And that should remain the bright spot really for CPP markets. But whether one type of product is enough to buoy an entire market, we doubt it here at Vortexa. And the outlook remains more of a mixed bag that tends to be pulling towards a cooling down once more of relatively high recent ton miles and elevated freight rates.
Thanks, Arthur. So to summarize, we think that China's refining industry is really marching towards a new beat of moving away from being export-driven to being more self-sufficient, and it is likely to stay its course. And under this new regime, the country's crude imports and product exports will likely remain range-bound. Now, the fact that we're seeing firm Middle East crude imports into China and the declining long-haul spot purchases has really dented the dirty freight markets, which will remain challenged in the fourth quarter of this year. But meanwhile, regional refiners such as South Korea, Taiwan, as well as Japan have really stepped up to fill in the supply gaps left behind by China. And in doing so, they've also found additional arbitrage opportunities to the west that is really supported by a seasonal rise in demand as well as supply tightness. We think that an upswing in Southeast Asian demand would go a long way in terms of supporting refining margins within the region as well. But in the meantime, we've seen that the clean tankers are benefiting from the long-haul product exports, although a further rise in the fourth quarter is unlikely. So with that, we've come to the end of the presentation, and we'll now take some questions from the floor. So let me have a look at some of the questions that have came through. Emma, this is one for you, perhaps. So the question is, what's the impact of dual control policies, such as the energy intensity and consumption control on the oil market?
That's a frequent asked question recently. Multiple provinces in China have taken measures like power rationing to force local industrial firms to cut their output in a bid to achieve their annual dual control targets. There were 9 provinces recorded higher energy intensity in the first half of the year, and 8 provinces recorded higher energy consumption. For example, Jiangsu was on both lists, and thus we saw 2 Sinopec refineries in Jiangsu cut runs in September in response to these measures. But in general, the state-run refiners' operations are largely stable, as they have already been capped by product export quotas since June this year. For independent refiners, some Shandong refiners have been impacted from the 1-month-long environment protection inspection that ended in late September. However, Shandong was not in the higher energy intensity or consumption list, and refiners there have received little guidance on next move from government. Therefore, the latest round of power restrictions is not expected to have a big impact on Shandong refiners' crude runs in Q4. To sum up, we expect minimal impact of dual control policies on China's refining industry, which is already restrained by other refining targeted regulations.
Right. Thanks a lot, Emma. I have a question for you. What do you think is the impact of OPEC's decision earlier this week on the tanker markets?
It's a good question, Serena, and definitely a timely one. To be honest, it wasn't the best news tanker markets could hope for. It's really the more the merrier when it comes to crude tanker markets. And the hope that OPEC would boost exports further than their previous planning to help cool rising prices was dashed early this week. Now, the incremental 400,000 barrels per day boost is simply not enough to help tanker markets, crude especially on the larger sizes, recover. And the market really continues to face the prospect of a miserable Christmas. To give an idea of the scale, the increase in output is equivalent to another 6 VLCCs needed that month. Whereas here at Vortexa, with our fleet distribution data, we currently count in excess of 300 uncommitted VLCCs east of Suez. So it really won't help move the needle much.
Yeah, it seems like a really tough market for Q4, isn't it?
Absolutely.
Thanks, Arthur. So moving on to the next question, I think I could take this one. How much gas to fuel oil switching opportunities do you foresee in Asia's power generation? I think this is really another good question. So generally in this season, many power generation plants in Asia are really scrambling to secure the alternative feedstocks, really in light of the surging LNG costs. And we see gas to fuel oil switching picking up most prominently in countries like Pakistan as well as Bangladesh. I think in my latest recollection, Bangladesh's high sulfur fuel oil imports last month is up over 15% compared to 1 year ago. And for Pakistan, its imports are up over 25% in the third quarter as compared to last year. Well, elsewhere in Asia, we're also hearing that several Japanese power utility companies are sourcing for low sulfur fuel oil, although many of them are sourcing the supplies domestically, and we have not seen a pickup in the low sulfur fuel oil imports going into Japan. For South Korea, it has only one fuel oil powered fired power plant, which is in Ulsan, and the East-West Power EWP has emerged to buy a few low sulfur fuel oil cargoes from the market. So we could see imports picking up from that front. So I think that, because of this gas to oil switching in Asia, has really pushed up high sulfur fuel oil market into a steep backwardation. And until the LNG prices cool, to become competitive with fuel oil, the high sulfur fuel oil market will remain tight. But that being said, I think the upside to this switching is very much kept by the capacity of fuel oil power generation plants, particularly in North Asia, because many of these power generation plants has previously been permanently shut a couple of years ago. Moving on to the next question, Emma. Have a question for you. What is the outlook of the Chinese crude imports in the first quarter of next year?
We expect China's crude imports to remain firm in Q1 next year, but with not much upside relative to Q4 this year. The Chinese government is unlikely to relax the current restrictions on crude imports or product export quotas. So fresh import and export quotas granted for next year will likely remain at similar levels to second half of this year. If oil prices remain elevated, refiners are likely to only buy sufficient volumes to maintain their refining runs and not likely to refill the inventories they drew this year. Furthermore, China's refining runs seasonally slows in February and March after the Chinese New Year, so we do not expect a rise in crude purchases.
Thanks, Emma. Looking at the time, I think we have time for one last question. So maybe Arthur, this one could be interesting for you. What do you think is the outlook for the gas carrier market?
Yeah, so the global gas market for shipping is currently the place to be in. I'd love to have an LNG vessel in my back pocket right now, to be honest. Owners are really making a killing, especially compared to other market segments. You know, on the LNG side, peak winter demand season is approaching. We've really got firm global gas demand, and that's showing no signs of easing. Inventories are still low. So, you know, it means not only demand for freight won't weaken, but I think we can expect the higher cost per cargo as well to trickle down to the cost of freights. And that's going to help freight rates remain strong till at least mid-2022, I would suspect.
Thanks a lot, Arthur. So with that, we've come to the end of the presentation. Thank you once again for joining us in our webinar today. We hope that you've enjoyed the session, and we look forward to seeing you in our next webinar. Thank you.
Thank you.
Cheers, everyone.